Right now, as you're watching this, something historic is unfolding in the metals market that most people have absolutely no idea is happening. The copper market just experienced a move so violent, so sudden, that it's sending shockwaves through every connected asset on the planet. A short squeeze of unprecedented proportions has detonated across Comex, and silver is going absolutely parabolic in response. If you haven't seen what's happening, you need to see this right now, because the implications are massive for your portfolio. This is the kind of market event that comes along once in a decade, and if you understand what's driving it, you're positioned to make extraordinary moves. Before we break down exactly what's happening and why silver is spiking 7% in a single trading session, hit that subscribe button right now and turn on notifications, because what we're about to explain will completely change how you understand commodity market mechanics. Comment below right now. Are you in on the copper squeeze, or did you miss this move? Over the past 72 hours, something absolutely unprecedented has transpired in the copper futures market on Comex, and the magnitude of what just occurred is being severely underestimated by the mainstream financial media. The copper market, which typically moves in measured increments and respects traditional technical levels with disciplined precision, has experienced a violent rejection of lower prices that has forced massive short positions to cover at catastrophic losses. This isn't speculation or theory. This is observable, quantifiable market data showing that traders who had bet copper would continue declining have been caught in a squeeze that rivals the volatility we witnessed during the pandemic-era commodity rallies. The setup for this copper squeeze began building over months of deteriorating sentiment, where banks and large institutions had accumulated enormous short positions, betting that copper prices would collapse further under the weight of recession fears and slowing Chinese demand. These traders built their positions at price levels they believed were absolute floors, areas where supply would overwhelm demand and prices would continue spiraling downward. What they didn't account for was a fundamental shift occurring beneath the surface, a reversal in physical demand dynamics that would later ignite this explosive move higher. Real demand for physical copper has been accelerating at a pace that contradicts the bearish narrative that dominated trading desks throughout the fall and early winter months. Manufacturing activity in Asia has proven more resilient than consensus expectations, and more importantly, the renewable energy transition and electric vehicle production continues on a trajectory that requires unprecedented quantities of copper wire, components, and industrial applications. This growing gap between what the market was pricing in and what was actually happening physically began to manifest in the spreads between New York and London copper contracts, with the spread widening to levels that haven't been seen in over 18 months. The spread between NYMEX and LME copper futures exploded to record territory, signaling that physical copper in London warehouses has become increasingly scarce relative to the massive overhanging short positions that traders maintained in the New York market. When spreads widen to this degree, it creates a feedback mechanism where any short covering in one market creates buying pressure that radiates across all linked futures contracts. The traders holding these short positions finally recognized the reality that the market had shifted, and they scrambled to exit positions that were hemorrhaging capital on an hourly basis. What started as isolated short covering in New York quickly metastasized into a panic that pulled in traders from London, Shanghai, and every other major copper trading hub around the globe. The market moved with such violence that position limits were tested, margin requirements were adjusted on the fly, and volatility spiked to levels that halted algorithms and triggered emergency trading curbs. This wasn't a gradual repricing of copper. This was a violent, urgent repositioning, where the bear case simply evaporated under the weight of cascading buy orders from traders desperate to close out losing positions before losses became completely unmanageable. The first component driving this historic squeeze is the fundamental mismatch between short positioning and available physical supply that has built up over an extended period. Large commodity trading funds and financial institutions had constructed betting positions that essentially assumed copper demand would crater alongside the global economic slowdown that many forecasted as inevitable. These positions were put on at higher price levels months ago, and as prices declined, these traders became increasingly confident in their bearish thesis. They doubled down, added to short positions, and prepared for a continued descent that would generate extraordinary profits once supply destruction finally kicked in. However, the copper market rarely cooperates with traders who become too confident in any single directional thesis, and this situation proved no exception to that rule. The fundamental backdrop for copper shifted while these short traders were complacently watching their positions slip into the red. Chinese demand, though not explosive, has stabilized at levels that are still historically robust by any reasonable measure. Infrastructure spending in China continues, electric vehicle production has accelerated dramatically, and global renewable energy installations are happening at a pace that requires continuous, voracious amounts of copper for wiring, transformers, and related electrical components. Meanwhile, supply disruptions have been quietly building across multiple major producing regions, with labor disputes in Peru affecting output and weather events in other regions constraining production timing and volumes. The London Metal Exchange warehouse inventories, which are considered the ultimate arbiter of physical copper scarcity, have declined to levels that make the massive short positions look increasingly untenable. These warehouses hold the physical metal that traders use to either settle futures contracts or deliver to end users. And when inventories shrink to critically low levels, the speculators holding short positions realize they may face the prospect of actually having to provide the physical metal to settle their obligations. The second major element amplifying this squeeze is the leverage and interconnectedness of the global financial system, which means that when one market moves with extreme violence, it creates ripple effects across seemingly unrelated markets. The copper squeeze began exerting downward pressure on the US dollar as traders liquidated portions of their portfolios to meet margin calls and cover positions, and as the dollar weakened, precious metals, particularly silver, become more attractive for both speculators and value investors. Silver is the poor man's gold, the more leveraged play on the precious metals thesis, and when real money starts rotating into the sector, silver moves with mathematical certainty. The technical positioning in silver was also loaded with short bets from traders who had become convinced that the precious metals complex was permanently broken, and that inflation had been conquered with such certainty that there was no reason to maintain any exposure to these traditionally defensive assets. These same traders who were short copper had corresponding short positions in silver, and when the copper squeeze forced them to cover in one market, they began evaluating their entire portfolio of short positions across multiple markets. Silver offered an attractive target for covering because the technical setup showed a market that was extremely oversold, with sentiment indicators flashing extreme pessimism and fewer market participants believing in any upside scenario. The moment the first major traders began covering their silver shorts, they triggered stop-loss orders from other traders who had shorted silver betting on continued decline, creating a self-reinforcing cycle where each covering action triggered additional stop-loss orders that pulled in fresh buying. This cascade accelerated rapidly as more traders recognized that the positioning in silver had become dangerously crowded on the short side, and the 7% rally we're witnessing now is actually the beginning stages of what could become a much larger move if the covering continues to gain momentum and fresh capital rotates into the sector, seeking exposure to what could be the beginning of a new precious metals bull cycle. The third critical element in understanding this dynamic is the sympathy play phenomenon, which is the mechanism through which moves in one commodity market create predictable buying pressure in related commodity markets where positioning has become similarly crowded. When copper surges on physical demand acceleration and short covering, it sends a signal to the marketplace that the commodities complex may be positioning to stage a more significant recovery than consensus had believed. This signal triggers a chain reaction of covering across related positions, not because fundamentals in each individual market have suddenly shifted, but because traders holding short positions across multiple related commodities recognize that the fundamental thesis supporting their entire portfolio of shorts may be deteriorating. Traders across the financial industry spend enormous amounts of resources trying to predict which markets will move together and how shocks in one market propagate through the financial system. The correlation between copper and silver is well established in trading circles, as both are industrial metals with significant financial demand components, and both respond to economic growth expectations and inflation dynamics in comparable ways. When copper rallies on strong fundamental developments, it typically signals that industrial demand is improving, and this improvement eventually feeds into all the other markets where similar positioning crowding had accumulated. What makes sympathy plays so powerful is that they operate on multiple timescales simultaneously, triggering immediate selling by short traders desperate to cover positions, while also attracting new buying from investors who are convinced that the market is pricing in a shift toward more favorable fundamental conditions. The silver market experienced both phenomena simultaneously, with shorts covering and simultaneously new capital pouring in from investors who believe that the copper squeeze represents the beginning of a broader commodities recovery that will ultimately drive precious metals substantially higher over the coming months. The technical picture in silver had been deteriorating for months, with prices declining steadily from highs above $33 down to levels below $29, and sentiment had become so bearish that many retail investors had given up believing that silver would ever experience a genuine bull market again. This extreme pessimism created the technical setup where sympathy buying from the copper squeeze could trigger explosive upside moves, because every level above the recent highs would represent territory that the market hadn't traded through in weeks, triggering algorithms to accelerate the buying as they recognized the potential for a trending move developing. The fourth element that amplifies both the copper squeeze and the silver sympathy move is the psychological dimension that operates in commodity markets during periods of extreme positioning crowding. When traders hold massive short positions in multiple related markets and then experience losses in one market, they frequently enter a psychological state where they begin questioning the fundamental thesis that supported all of their short positions. This self-doubt leads to panic covering that often produces moves far exceeding what fundamental changes would normally justify, because the selling is driven not by rational reassessment of fundamentals, but by raw fear of additional losses. The copper squeeze has triggered this psychological dimension across the commodity trading complex, and it's manifesting most dramatically in the precious metals space, where sentiment had already deteriorated to multi-year extremes. Traders who had been confidently shorting silver at prices near $28 are suddenly scrambling to cover positions as the 7% rally proves them wrong. And this scrambling accelerates the very move they're trying to escape, creating the parabolic action that defines genuine short squeezes, where the price move itself becomes the dominant driver of additional price moves. The current copper squeeze has forced traders to confront the reality that their bearish thesis regarding global demand was premature, and that they had accumulated positions at sizes that made them vulnerable to the exact kind of physical supply disruption that's currently occurring. As these positions unwind, they pull in sympathy covering across related markets, and silver has become the focal point of this activity because the positioning there was even more crowded on the short side relative to the actual fundamental conditions driving demand and supply dynamics. Looking at the current positioning data and the velocity at which the copper squeeze is forcing covering, the potential for the silver rally to extend significantly beyond the initial 7% surge appears substantial if the covering momentum continues to build. Traders who shorted silver at levels near $28 are now facing losses of more than 2 to 3%. And if prices break above $30 with conviction, the losses for these traders will reach psychological levels that trigger panic covering rather than methodical unwinding of positions. The copper squeeze represents a market-wide recognition that the bearish thesis regarding commodities and global demand had become overcrowded and had embedded itself into positioning that was dangerously vulnerable to even modest shifts in fundamental conditions. When this recognition crystallizes in the minds of traders holding massive short positions, it doesn't matter whether the shift is dramatic or subtle. The covering that results from the realization that the thesis is broken creates the exact kind of violent repricing that we're witnessing across copper, silver, and the broader commodities complex right now. The implications of this copper squeeze and the sympathy move in silver extend far beyond just the 2-week trading timeframe, because they signal that the largest traders in the commodity space are beginning to reposition away from bearish positioning and toward positioning that acknowledges the possibility of sustained commodity price strength. This repositioning, once it reaches a critical mass, becomes self-reinforcing, drawing in hedge funds, pension funds, and retail investors who recognize that the fundamental backdrop for commodities may have fundamentally shifted over the past several months. What began as an isolated short squeeze in copper has metastasized into a broader recognition across trading floors that positioning in the commodity complex had become dangerously one-sided, and the clearing of this one-sided positioning through sympathy covering in silver and related markets is only the beginning stage of what could become a much larger reallocation of capital toward commodities and away from the positioning that had assumed permanent commodity weakness. The traders currently exiting copper shorts are simultaneously evaluating their exposure across all commodity-related positions, and this holistic reassessment is driving the 7% move in silver that we're witnessing right now. This move is not the conclusion of a correction, but rather the beginning stage of what could develop into sustained precious metals strength if the covering continues to gain momentum, and if new capital begins rotating into the sector based on the recognition that a significant shift in positioning has occurred. Keep watching this space, because the copper squeeze is far from over, and the sympathy buying in silver that it's generating could accelerate dramatically if the covering gains the kind of momentum that would draw institutional capital into the sector. The metals are positioning to stage something significant, and understanding the mechanics of how short squeezes propagate through related markets is the key to positioning yourself ahead of the larger moves that typically follow these kinds of extreme positioning events.